Hi guys, welcome back to In Case of Econ Struggles. Today we're talking more about taxes. Specifically, we're going to talk about taxes graphically and analytically, talk about the difference between incidence and burden, and then we'll do a numerical example. Let's start off by reviewing taxes. So in this example, I've placed a tax on the seller, so we're shifting the supply curve from this blue line to this light blue line here. Now before the tax, we were at this nice equilibrium point, P star and Q star. When we shift the supply curve based on the tax, we're going to move down and have less quantity to QT, and the buyers are going to pay this orange price here, PB. The sellers are going to receive this magenta price, PS. And the difference between PB and PS is going to be the size of the tax. So automatically, without even knowing what the exact number is, I know that the difference between this orange dot and this magenta dot is the size of the tax. Now, I'm going to argue that no matter who we put the tax on, it's not going to matter. How do I see that? Well, if I put the same tax on buyers instead of sellers, we're shifting the demand curve in, and notice the rest of the picture looks exactly the same, whether or not we're taxing sellers or buyers. And that's because if we place it, say, on sellers, the sellers are going to pass through part of the tax to buyers because they are not going to swallow the entire tax themselves. They're going to make the buyers pay it with higher prices. Now let's talk about the difference between burden and incidence, two words that might seem sort of the same when we talk about them with respect to taxes, but are actually different. So the burden is who the tax is on. So in that example, I've taxed the sellers, but incidence is how much of the tax is paid by each side in the market. If the sellers are only going to pay like 60% of the tax, they have a 60% incidence, even though their burden is 100% because they are the ones being taxed. Now, the burden is just equal to the tax amount T, and the incidence is calculated as, well, the incidence for the buyer is how much of the tax the buyer pays divided by the total amount of tax. Similarly, the incidence of the seller is the tax that the seller pays divided by the total amount of tax. So this is going to be a percentage here, and the tax the buyers pay plus the tax the sellers pay should be equal to the total tax. As I've said before, the tax can also be found as the price the buyers pay minus the price the sellers receive, and that's the tax amount. Again, we can see that on this picture here. Now let's talk about the relationship between tax incidence and elasticity. We've talked about elasticity in a previous video. Feel free to check that out if you want a refresher before we get into this. Here is our example that we started with. Notice that supply and demand have similar elasticities. Note that I'm using straight lines instead of curves so that each of these have the same elasticity along the entire line. We know that's not always the case, but in this straight line example it is. So here the elasticities are pretty similar. Notice that buyers and sellers are paying roughly half the amount of tax. But if I make the demand curve super inelastic and I make the supply curve super elastic, notice that the price the sellers receive after the tax is about the same as what they were receiving before, but now buyers are basically having to swallow all of the tax. So here it seems like the more inelastic side has to pay more of the tax. And if we do the opposite, you'll see that's true as well. So now if I make supply really inelastic and demand really elastic, after the tax, the price the buyers pay is roughly the same as what they paid before, but now the seller is swallowing all of the tax, and that's when demand is elastic and supply is inelastic. The reason this makes sense is because if I, as the consumer, have really inelastic demand, then I am not going to change how much I buy even if the price goes up. So if the seller sees that the government is placing a tax on them, they know consumers are willing to pay a higher price and they won't see that big of a drop in quantity. Well, then they're going to update the price the buyers pay. They're not going to receive any less. They're going to 100% pass that tax through to the buyers. The buyers are going to pay the tax even though the burden was on the sellers. Here are some key takeaways. Burden is not equal to incidence. That's what we've talked about pretty extensively at this point. We know that the more inelastic side is going to pay more of the tax. They're going to have a higher incidence because that more inelastic side is going to be less responsive to price. So passing through the cost to that side makes more sense. So for example, if you've got higher demand elasticity, the seller can't pass through as much of the cost, so they're going to receive less. But if demand is really inelastic or not as elastic, then the seller can pass through a lot of that tax to the buyer, and the buyer will end up paying more of the tax. Let's see how this works in a numerical example. So in this numerical example, I've got a supply and a demand curve that I just came up with, and I'm going to solve for equilibrium quantity, equilibrium price, set the quantities equal to each other, find my equilibrium price, find my equilibrium quantity. Here's my P star and my Q star. P star is 7, Q star is 13. I'm going to tax the seller $2 per unit. This means that the difference between the price the buyers pay and the price the sellers receive is $2. So I'm going to update the supply curve to account for that, to say that, well, PS is equal to PB minus 2. I'm going to go through that math, and I'm going to get the price the buyer pays is 25/3. I'm going to subtract 2 from that to get the price the seller receives to get 19/3. Notice that 25/3 minus 19 over 3 is 6 over 3, or the size of the tax, so I know I did that correctly. Quantity of the tax, well, I'm just going to use the demand curve because it's easy. I'm going to get 60 over 3, which is just 20, minus 25 over 3 equals 35 over 3. Okay, so I do another check. 35 over 3 is less than 13, which is Q star, so I must have done something correct. And now I've solved for Q tax, the price the buyers pay, the price the sellers pay, as well as Q star and P star. So now I have completed this graph. If I want, I can really zoom in on that price axis to see, okay, this is 7 or 21/3, this was P star. Notice that demand was less elastic, so they should pay more of the tax. And indeed they are paying 4/3 or 67% of the tax, even though their tax burden is 0. Supply side, they're more elastic, so they're gonna pay less of the tax. So even though their burden was $2, they're only paying 2/3 of the tax, or about 33%. Now I say more elastic and less elastic. Remember that we can calculate elasticity using the demand curve. So the absolute value of the demand elasticity is 1, the absolute value of the supply elasticity is 2. So supply is more elastic than demand, and we would expect the demand side to pay more of the tax. So hopefully this numerical example just brings it all together. If this video was helpful in understanding taxes and tax incidence, make sure to like and subscribe, and we will see you next time for another case of econ struggles.